Welcome to the deep dive. So if you've been glancing at the headlines, the financial ones anyway, you might think the market's doing brilliantly. We're near all-time highs on the big indices. Looks great. But, if you're actually managing money right now, there's something else going on.
Oh, absolutely. It's a bit of an illusion, really, that
Yeah,
stability, because
illusion.
under the surface, it's much tougher. Lots and lots of individual stocks they're really struggling.
Right.
And that gap between the handful of big winners and everyone else, it's getting wider, fast.
Okay, so let's try to make sense of that chaos. The trigger, it seems, for this latest turbulence was the Fed.
Yeah, the Fed action.
We got the rate cut everyone expected, 25 basis points. Now, normally that's champagne time, right?
Mhm.
Cheaper money, lower borrowing costs.
That's a theory, yeah.
Yeah.
Textbook reaction. But Fed Chair Powell, he kind of poured cold water on it almost immediately.
Yes.
Well, he was pretty explicit, saying a December rate cut is, far from a sure thing. Lots of uncertainty injected right there.
Ah, okay. That language, that ambiguity, that was the key.
That seems to be the trigger, yes.
And uncertainty hits, capital gets nervous.
Exactly.
And that one comment, our sources are saying it ignited a vicious sector rotation.
Vicious is a good word for it.
So that's our mission today, really. We need to trace where the money's actually going, where is it fleeing from, and maybe more importantly, where are the new winners being bought up?
Right, because it proves that just buying the index isn't enough. Careful stock picking, that's what's critical now.
Okay, so where do we start this great market dichotomy you mentioned?
Yeah, we have to accept that the headline number, the index level, it's kind of lying to us.
Oh.
Well, look at the standard S&P 500. That's weighted by company size, market cap. On the surface, it looks fantastic, up over, 18.5% in the last year?
Sounds great. That's the number you hear on the news.
Right. But then look at the average stock. If you take the S&P 500 equal weight index, so every stock gets the same importance.
Okay.
The picture is totally different. The average stock in the S&P 500, it's up just 5.6%.
Wow, okay. 18.5% versus 5.6%. That's a huge gap.
It's massive.
Yeah.
A 13-point difference. And it's not just, a weird stat. It tells you everything about this market.
What's that?
The concentration issue. It's historically extreme. The top 10 stocks in the S&P 500, they now make up, get this, 40% of the entire index.
40%, just 10 stocks.
40%.
Yeah.
So, yeah, almost half the money going passively into the S&P is just buying those 10 names.
What does that mean? Is that like a systemic risk, that level of concentration?
It definitely creates fragility.
Yeah.
If those top 10 stumble, the whole index gets dragged down no matter what the other 490 are doing.
Right.
But for someone actively investing, it just hammers home the basic market law. Supply and demand. That's what drives trends. If everyone's piling into just 10 stocks, the other 490 get left behind. The tide isn't lifting all boats anymore. You got to pick your boat carefully.
Got it. So capital's concentrating, and now it's rotating hard because of what Powell said.
Right.
We need to measure that outflow, the real selling happening underneath that shiny index number. How bad was this rotation yesterday, for instance?
Well, for that, we look at the big money index,
Yeah.
the BMI. It tracks institutional money flow across thousands of stocks. Gives you the clearest picture of what the big players are actually doing.
And what's it saying?
It's flashing warning signs. It's been falling pretty steadily for about 6 weeks now.
Okay.
Right now, it's sitting at 61%. That's the lowest it's been since back in May.
61%. I mean, with the market near highs, that doesn't immediately sound like panic stations. Why is that level concerning?
It's the trend and the context. When the BMI drops this much, it means institutional conviction is really drying up. Reading down your 60% historically signals that sellers are starting to significantly outnumber buyers.
So the big institutions are losing their appetite outside those top few names.
Dramatically shrinking appetite, yeah.
And this selling, these outflows, they got really intense yesterday, October 29th.
Oh, yeah. Violent is the right word. It was a huge capital shift. One of the biggest single distribution days we've tracked all year, actually.
Wow.
Yesterday saw the second largest amount of equity outflows since the market bottomed out back in April.
Okay. And how does market breadth look? Does that confirm the damage?
It absolutely does. Breadth is, it's crucial for checking the market's internal health.
Remind us quickly how we measure breadth here.
Pretty simple, really. How many stocks saw institutional buying, the inflows, versus how many saw institutional selling, the outflows?
Okay.
Yesterday, only 122 stocks had measurable inflows, but 224 stocks saw measurable outflows.
So nearly twice as many stocks being sold hard as being bought hard.
Exactly. And that is the second worst breadth reading since April. It screams underlying weakness.
So if you own stocks outside those maybe top 10, top 20 mega caps?
Your portfolio probably felt that terrible breath yesterday.
Yeah.
A lot of pain under the surface.
Okay, that makes the big picture clear. Institutions are selling more broadly. Now, where exactly is the money leaving from? Which sectors got hit hardest by this rotation after Powell spoke?
The selling, the heavy distribution, it was pretty widespread across 6 main sectors.
Which ones?
We saw big outflows in discretionary, financials, industrials, real estate, staples, and technology.
Okay, thinking about the why. Why those 6? What's the connection?
Well, look at real estate and financials. They are super sensitive to interest rates, right? Leverage, debt costs.
Yeah, makes sense.
So when Powell introduces doubt about future rate cuts, maybe hints rates stay higher for longer, the cost of capital for those businesses immediately looks worse.
So the smart money pulls back first from those vulnerable areas.
Instantly. Yeah, it's not just random retail panic selling. This is large-scale, systematic de-risking by the big money managers. Exactly. And linking back, these flows, they aren't just one-day blips. Often these are trends that have been building for weeks, sometimes months.
Okay.
When big funds decide to get in or out of a stock or a sector, they do it methodically.
Yeah.
That's what creates these accumulation or distribution patterns we track.
Right. Let's make that concrete. Can we use industrials as an example? See this systematic selling happening?
Sure. Industrials yesterday, definitely leaning negative overall.
Okay.
We tracked 27 stocks within the sector seeing inflows,
Okay.
but 39 saw outflows. And that number, 39 stocks seeing distribution. That's the highest number of sellers in industrials in 6 months.
Wow. So pressure is definitely building on manufacturing, logistics type companies.
Accelerating, yeah.
Okay, this is where it gets really interesting, I think. Connecting that flow data to what actually happens with companies, their earnings. Let's look at maybe 2 stocks in industrials, a winner and a loser, see if the flows told the story beforehand.
Good idea. Let's start with an outflow example. Cintas, ticker CTTS. They do business supplies, uniforms, that sort of thing.
Okay, Cintas. What did the flows show?
Nothing but outflows. For the last 3 months straight, big money has just been systematically selling it off week after week, month after month.
Selling for 3 months. Okay, now let's contrast that. Same sector, industrials, but a big winner. Caterpillar, CAT, heavy machinery.
Right, Caterpillar. They just blew away earnings expectations earlier this week. Sales, profits, everything beat estimates.
Yeah, I saw the headlines. Seemed like a big surprise.
Well, it was a surprise if you only read the headlines. But if you were tracking the money flows, the surprise was about 6 months old.
6 months? How so?
Caterpillar had been seeing heavy accumulation, big institutional buying for 6 solid months leading up to that earnings report.
Ah, so the institutions had already figured out something was going well there.
Exactly. The money flow data identified this winner, this outlier, way before the news hit. It really proved the predictive power here. Follow the flows and you can spot these things early.
That is powerful. The accumulation was the real story. The earnings beat was just confirmation lagging behind. Okay, let's pivot to technology. You said that was bifurcated too.
Yeah, very split. Yesterday was almost even. 26 inflows versus 29 outflows. But that hides some massive moves underneath.
Like what?
Well, huge pain in Fiserv. Ticker FI, payment processing company.
What happened there?
Oof. They missed earnings badly. Guided way lower for the future. Announced management changes too. The stock just cratered. Down 44% yesterday.
44% in one day. That's brutal. Was that purely the earnings news, or did the flow data give any warning?
The news was definitely the catalyst for that scale of drop. The management change added fuel. But was it a total shock? No.
Right.
The data showed Fiserv had been for sale institutionally for 6 months, just like Cintas. Capitals is systematically leaving. We couldn't predict a 44% one-day collapse, obviously, but we knew it was under serious pressure.
So institutions were already lightening up or getting out before the cliff dive.
The smart money was heading for the exits, yeah. The bad news just triggered the final rush.
Okay. And on the other side of tech, where is the money flowing into?
There's still huge money going into SanDisk, SNDK, storage devices.
SanDisk. We talked about that theme before, didn't we?
We did, about 2 weeks ago. And it's still holding up incredibly well. Really outsized institutional demand, pushing that stock higher, despite all the churn elsewhere in tech and the broader market jitters.
Okay, so pulling this all together, what's the main message for someone trying to navigate this? It sounds pretty treacherous.
Yeah, the core takeaway is really clear, I think. That Fed rate cut, it looked good on the surface, but underneath it cause real pain and gain.
Right.
The market noise, the high index level, the earnings surprises, misses it off and hides. These much more important longer-term capital trends. You have to look deeper.
So basically, you can't just ride the index wave anymore. You need laser focus. You have to be in the right stocks, the ones attracting that institutional money.
Precisely. The key thing for you, the listener, is that these institutional trends, they are detectable. Tomorrow's big winners, stocks like Celesta, Supermicrocomputer, NVIDIA, they were all outliers, spotted early by tracking this kind of big money data.
So the signals are there if you know where to look.
They are. The lesson is pretty simple. Trust the flow data more than the daily headlines or the index level. If you see that steady accumulation, you hold on tight and try to avoid getting spooked by these big sector rotation scares.
That's a very actionable insight. Trust the flows. Okay, that leaves us with a final thought, something for you listening to ponder on. Given this huge difference we've discussed between the S&P 500 index performance and how the average stock is actually doing, how much of this market strength we see in the headlines is really just an illusion created by a tiny handful of mega-cap stocks?
And maybe what happens to the rest of the market, and maybe even the index itself, if that concentration starts to crack.
Something to think about as you navigate this very, very focused investment world right now.